it is my esteemed pleasure to introduce Mr. and Mrs. Donald Trump.
It's the Donald! Oh my God!
Look, folks, before we go too far, I've got something to tell you.
Excuse me, but I've got something to tell you first. Thank you for ruining my life!
Ashley!
What did you do?
Everybody's always blaming me for everything.
Our biggest problem in evaluating Trump is we don't know what he'll say tomorrow. You can't run Washington like you run a business, and that's always been a mistake to think that you can, because it isn't a business. Tomorrow there's a beginning of an economic bust like it happened in 2008. But Trump's not responsible for that, but he'll get blamed for it.
Hi, I'm Mike Maloney, and I want to thank you for being here. The reason that I'm making this video is I believe that there is something very big and very dangerous coming at us very fast right now, and I want as many people to be prepared as possible. This is the first time in history that there has been an everything bubble. This, back in the year 2000, it was stocks. In the year 2008, it was stocks and real estate. This time it is stocks, real estate, and bonds, and they're all in some of the biggest bubbles of all time. And when this bursts, it's going to be devastating for most people, but it doesn't have to be devastating for you. So this is how to survive the next 4 years.
Do we think we have a crash before the end of the year? I mean, is that your candy?
Absolutely.
Big crash before the end of the year. Would you target fall?
Yeah, I would target sometime between August and November, because that's when the rubber is going to meet the road on a debt ceiling increase, when they're out of cash, when Washington is going to really end up in vicious political conflict over what to do about the debt ceiling. The main thing, seriously, is get out of the markets. These markets are unstable, they're rigged, they're unsustainable. There is no reason to own stock at this point of the game. It is so overvalued that maybe you can get another 2 or 3% up, but you're facing a 30 or 40% down. The risk reward is horrible. The bond market is one giant bubble because the central banks have been buying all of these bonds worldwide. They've been buying trillions. Right now they're still buying $1 trillion or so on an annual basis, but all of that is coming to a halt. The Fed has finally run out of dry powder. They're out of the bond buying business and are even talking about initiating the shrinkage of their balance sheet, which clearly needs to happen. The European Central Bank now is essentially near the end of its money printing spree, because the Germans have had enough of it. Even in Japan, which has gone off the deep end with QEE and money printing of a just crazy dimension, even they are beginning to have second thoughts. And even in China is what I call the red Ponzi. The government there is struggling desperately to try to slow down the growth of credit and speculation and bubbles everywhere, from commodities to housing to just overinvestment in the Chinese economy. So my point is, everywhere in the world, the central banks are finally getting to the end of the road. There isn't going to be any more money printing, and that's going to leave a giant mess on the doorstep of all the fiscal authorities, and it's going to make the bond market a particularly dangerous place, because bonds are totally mispriced. In other words, if the central banks had not bought 20 trillion worth of government bonds, I'm talking worldwide now, over the last 2 decades, the yield on debt everywhere in the world would be much higher, several hundred basis points. The price of bonds accordingly would be commensurately lower, and therefore you have, in what is roughly a 100 billion global bond market, 100 trillion, excuse me, a giant 100 trillion global bond market, corporate and government, the biggest bubble that's ever seen. So the advice is get out of the bond market, get out of the stock market, buy some gold, and keep buying gold, not all at once, but slowly, because when the financial system finally unwinds and the monetary authorities are totally discredited, which is, I say, is coming soon, I think the one hard asset in the world that people have believed in for centuries is going to have another day in the sun. And remember, the gold market is relatively small compared to the size of the equity markets of the world, 70 trillion, or the bond markets, 100 trillion. The gold markets are only a fraction of that. And so when the panic comes and the stampede into something, the ultimate safety net or safe haven occurs, I think the price of gold is going to rise dramatically.
As time goes on, it's becoming abundantly clear that Trump isn't going to be able to prevent a major financial crisis in this country. Depending on your beliefs, that's either because he's inept in some way, or because he's being hamstrung by a political system that's determined to keep our nation on the same unsustainable path. Whatever the case may be, it seems that there is no way that we can change the course at this point. We're headed for a financial crisis, and it's going to happen sooner rather than later. That's also the opinion of David Stockman, a former congressman and director of the Office of Management and Budget under Ronald Reagan. In this interview, he reveals why the market rally that broke out after the last election was the greatest suckers rally we have ever seen. He also explains why the economy could go off the rails this year after our government endures a major budgetary crisis. Earlier this month, our government avoided a shutdown because Trump decided to sign Congress's $1.2 million spending bill. In effect, he postponed a serious fight with the Congress for later this year. On May the 2nd, he tweeted, "Our country needs a good shutdown in September to fix the mess." So clearly, next time he's going to be a lot less compromising in his efforts to change the budget. That's going to spawn a fight over the budget between Trump and both political parties. And according to Stockman, that's when the next wave of our financial collapse is going to arrive. There will be no bid for the stock once the panic sets in. We're going to hit an air pocket. The S&P 500 is going to drop by hundreds and hundreds of points sometime over the next few months as we drift into the unexpected crisis. I would target sometime between August and November because that's when the rubber is going to meet the road on a debt ceiling increase when they are out of cash. Washington is going to end up in vicious political conflict over what to do about the debt ceiling. It is going to be one giant fiscal bloodbath, the likes of which we have never seen. That fiscal bloodbath is going to be the first domino to fall because the stock market and the bond market crash, both of which are extremely overvalued. The main thing is get out of the markets. These markets are unstable, they're rigged, and there is no reason to own stock at this point of the game. It is so overvalued. Maybe you can get another 2 or 3% up, but you are facing another 30% or 40% down. The bond market is one giant bubble because the central banks have been buying all these bonds worldwide. They've been buying trillions of dollars worth, and they are still buying $1 trillion worth on an annual basis. All that is coming to a halt. The central banks are finally getting to the end of the road. There isn't going to be any more money printing, and that is going to leave a giant mess on the doorstep of all the fiscal authorities. It's going to make the bond market a particularly dangerous place. There is a $100 trillion global bond market, and this is the biggest bond bubble the world has ever seen. When this happens, Stockman believes that the only thing that will remain standing is gold and other physical assets. Make sure that you're prepared for it, because a financial collapse is going to happen, and everything that only exists on paper is going to take a hit. Gold analyst Mike Maloney believes that traditional assets will plunge, and gold, silver, and cryptocurrencies like Bitcoin will outperform as investors seek protection from the coming collapse of the global dollar system. In the stock market, a few vulnerabilities have emerged. The ratio of debt borrowed against investors' brokerage account balances has reached all-time highs, which tells you that recent gains are vulnerable to a short squeeze, which is when brokerages close clients out of their positions. The VIX, a gauge of expected volatility, has fallen to multi-decade lows, suggesting that markets have grown complacent in the face of coming crash. Earnings per share ratios are looking precariously stretched to dot-com era levels.
So let's get into the evidence right now and take a look at it. Let's start the everything bubble with the stock market portion of the bubble. I'm going to present a few charts here, but they're fairly easy to understand, so stick with me. This is data compiled by Dr. Robert Shiller of Yale University, and he's gone all the way back to the 1880s and compiled what's called the price-earnings ratio. He's recreated the S&P 500 by putting together the 500 largest companies in the United States at the time, going all the way back into the 1880s. And the price of a stock versus how much the company is earning is a very good measure of whether a stock is overvalued or undervalued. And if it's priced down at 4 or 5 or 6 times earnings or 10 times earnings, it's a bargain. If it's priced above 15, it's too expensive. If it's priced above 20, it's in a bubble. And what you see here is that right now we're at a PE ratio. The price is 29.19 times the earnings of the company per share. And the only times that it's ever been in a bubble this big was a few weeks at the end of 1929 before the stock market crash, and a couple of years, 1999-2000, when the NASDAQ crashed. And so this is saying it's in a hyper bubble. It's even far higher right now than it was in 2007 when the stock market crashed, and that was the global financial crisis. So it's in a bigger bubble than it was back in the 2007 peak. This is margin debt. And one of the things that's important about margin debt is when people buy stocks by borrowing currency to pay for this stock, they can get what's called margin call. If the value of the collateral, the stock, drops too low, the brokerage house will make that investor or trader cough up a bunch of currency and pay to bring their equity up to a level where they're still comfortable letting them have the loan. And so margin debt goes along with complacency. When people are complacent and they're not pricing risk into the market, they tend to gamble and go further out onto a limb. So right now, margin debt is up at an all-time high. So here's the S&P 500, and this is how much margin debt, how much traders have borrowed versus credit balances in their accounts where they're sitting on cash. And right now it's at an all-time high. Another way of looking at that is margin debt as a percentage of the economy. But this is the volatility index. This measures whether investors are nervous or complacent. And when they're not complacent, they're not pricing in all of the risks of some sort of event in the market. And what you see here is that the volatility index in 2007 dropped down to very low levels of just 10. And today, it's at the same level that it was at back in 2000, the peak in 2007, when investors thought that nothing could go wrong, that everything would keep on going up forever. So complacency is at a maximum. Pricing in risk into the markets, that's at a minimum, and we are leveraged out to where this is the margin debt as a percentage of our economy, and this is at an all-time high. And that's dangerous. What it says is that if there's a crash, this crash is going to be very fast because there's going to be a lot of margin calls. Margin calls force investors and traders to sell positions so that they can come up with cash. So they've got to liquidate a whole bunch of their portfolio to come up with cash to give to the brokerage house, and that causes the crash to happen a lot faster.
And finally, a look at intraday trading patterns also reveals signs of strain. Maloney, borrowing from research of John Hussman of Hussman Funds, the former University of Michigan finance professor who famously predicted the 2008 crisis, explains that lately he's seen what he calls exhaustion gaps, appearing with increasing frequency. Hussman defines an exhaustion gap as any time the S&P 500 opens 0.5% above its previous close, while it's within 2% of its all-time high. These gaps show that the supply of capital pouring into the market is thinning, or that there are no more suckers willing to buy at the top.
What is driving the market right now is the fear of missing out. Somebody sees their neighbor making cash and they want to jump on that train also. And a gap in the market is something you need to know about before I show you his chart. He didn't explain what a gap was in his article. But when a stock is going up and trading during the day, and there's a range to that trading, and then the next day it gaps up and opens up at a higher level than it was the previous day, and it doesn't come back down and visit that same trading range, it leaves a gap in the chart like that gap and this gap and this gap and this gap. Now, those gaps are a certain signal that something is going on, and one interesting thing about gaps is there was a study recently where they studied the Dow Jones Industrial Average, which is 30 stocks, and each of those 30 stocks was studied separately, and the people that were conducting the study found that over 91% of the time, the market will come back down to fill those gaps. It'll cover that area. There's some gaps right now. The market will it's got a 91 to 92% chance that it's going to come down and fill those gaps. Now, John Hussman found that when gaps of greater than 0.5% occur within 2% of the all-time high, and this chart is within 2% of the all-time high of the S&P 500, that is a signal that there's an exhaustion of the market, that a lot of the currency that's available, the potential suckers, if you will, getting into a market at the top, the number of those, the amount of currency that can come into the market is becoming exhausted. And he developed an indicator where if it's within 2% of the peak of the market, the all-time high, and these gaps occur of greater than 0.5%, that's an indicator that we're near a market top. Now, the S&P only goes back to 1950. So he also included the Dow Jones Industrial Averages, which go back all the way back before the crash of 1929. And he added some even greater filters. The stock market has to be in a condition where more than 50% of the advisors are bullish, and where the Shiller PE ratio that you saw earlier is above 18. And like I said, we're above 29 right now. And when he did that, you can see that this indicator flashes at certain times, and it was just weeks before the 1929 stock market crash. And then weeks before the pullbacks in the 60s, and this pullback in the 70s where it flashed right at the top, that was a 50% market retracement. So you had 50% losses that you could have avoided if we had access to this data back then. Right at the peak of the 1987 stock market bubble and then crash, it told people, this indicator would have told people to get out of the markets before that crash. It flashed a few months before the peak in 1999-2000 when the NASDAQ crashed. It flashed right at the very peak of 2007, and it's flashing again, but it hasn't just been one indication that the stock market is topping. It has flashed 5 times now in just the past few months. So this is eerily similar to the last time around. We're at the peak of a bubble. Everybody thinks that this can go on forever. Market internals are deteriorating. The stock market is way overvalued, and we're way overdue for a recession, just like the last time around. The answer is gold and silver. The last time around, if you had switched from stocks to gold and silver, even if you were a year early and stocks continued running up another 10%, when they crashed, the stock market crashed 62.8%. But gold rose significantly, and there was a pullback when the stock market was crashing because of margin call. Any trader that had both gold and other stocks on his platform had to, if he was out on margin for the other stocks, he had to liquidate his gold also to pay the brokerage house. And gold ended up gaining 40%, where you would have lost 62.8% in the stock market. And the one thing, Warren Buffett, his number one rule is don't lose money. The number 2 rule is don't forget rule number 1. And the reason he says that is because if you lose 50%, you have to make gains of 100% just to get back to even. And it's hard to make gains of 100%. It's not a real easy thing to do. So losses are very hard to recover from. You want to try and prevent them at all costs, and now is a time to try and prevent them.
Finally, if you're new here to the channel or you've been spinning around our videos for a while, be sure to give a tap to that subscribe button there and turn on the notifications so you'll know the next time we post a brand new video. God bless you.